Have we been broken by the lack of liquidity?
It is a huge challenge. I'm hoping it doesn't break us, or not irreparably.
Welcome back to the Data Minute Podcast. I'm your host, Peter Walker, here at Carta. Now, today I was absolutely thrilled to be joined by Beezer Clarkson, who is a partner at Sapphire Ventures. She's the host of the Origins podcast. She's a general multi-hyphenate around the world of startups and VC. I'm sure you've read or listened to her already. We had a wonderful conversation. We touched on so many interesting topics, some of the most red flags of today around liquidity, what's going to happen with secondaries, how does this become a permanent feature in the startup landscape? We, of course, touched on the influence of mega funds and whether or not there are enduring advantages for emerging managers, even in a world of low liquidity. We then kind of spent some time talking about how emerging managers should think about pitching LPs, qualitative storytelling alongside hard metrics. Beezer is a fount of information around the world of emerging managers and how they can really stand out to their future funders. And then we wrapped up around the LP side, why Sapphire seems to be one of the few LPs that is really invested in content, and why we think that the LP world could do a lot to illuminate what's going on with more thought leadership, more content, more podcasts. LPs, we want to hear from you. Let's jump into the conversation now. Beezer,
Yes.
Thank you so much for being here. I am a longtime fan. I listen to your pod. I read all of your stuff. And I'm really honored that you're here.
Well, the feelings are mutual because I read everything you write in all the forums and I listen to your pods. And I am so glad to be here. And it's nice to meet you in person after all the years of online friendship.
We were talking that it is much more common occurrence these days to have a parasocial relationship with someone. And so you're even more dazzling in person than you are online.
Thank you.
That's amazing.
The Wimbledon look from walking down Bush Street.
Sure, yes. And we did not have hair and makeup for you this morning, so any fault of that is ours. We take the hit there. We were just having a really interesting conversation about podcasts and content and everything, but you brought up a more germane venture conversation where I wanted to start.
Okay.
Which was this discussion of the mega funds and how they are distorting or not distorting the earliest part of the venture market. Now, it seems like I have heard this a lot, and tell me whether or not you would agree that this is the prevailing sentiment, which is mega funds are kind of screwing it up for emerging managers because they come in and they take option calls in all these companies. And so they don't really care too much about the economics at the early stages, whereas an emerging manager can get priced out of these deals and therefore is left with quote unquote nothing. Do you think that's what most people are thinking right now?
We hear the same dialogue consistently. And I think, as I was telling you before, we're running the numbers. So stay tuned.
Sure.
We'll work together on this.
Absolutely.
And we'll have better data because my Achilles heel is if I don't have the data, I always cringe on making absolute statements because intellectually it drives me bonkers.
So that's weird. When I don't have data, I just make it up. So
I should become more like that.
yes.
But I would say it's a consistent discussion. And I was just at a seed conference yesterday. And it seems, my sense is it is very active with both mega, so we define that as over 500 million, or multi-stage funds because they have to write bigger checks. And when they get involved, you see this in your data, the valuations do go up, the round sizes do go up. But the question is that all of the deals and is that the best deals? And as it relates to emerging managers, there's an active dialogue of there should be room for everybody is sort of, I think, the simple bottom line, because if you're an emerging manager or if you are in a big fund, but you're, for whatever reason, newer to the game and have more connective tissue to the next generation of founders, the whole connection point is, can you get to these people first? And can you lock the deal down early? And then you can get out in advance of these big checks. And because they have other needs that these smaller funds, be them emerging or established, don't necessarily have to do. You do not have to get 25 million into the deal.
Sure.
And so it gives you more nimbleness and latitude. And it also, if you can be out there faster and sort of in the weeds of it all, you can also connect with folks faster. And then it becomes a bit of a, can you win the deal? And as an LP, we're looking for those folks who can win the deal, because whether or not they're great deals, if someone's crystal ball can tell you that on day one of a pre-seed, please call me.
Right.
But
you're in the market.
The market. But the reality is, I don't think people know. You make the best judgment call that you can.
Sure.
But time will only tell, because the world happens to these companies. and things can break their way, or like today, where a lot of things are not breaking people's ways because of macro decisions other people make that none of us could foretell or control.
Yep.
Right.
It actually is adjacent to another conversation, which I hear a lot, which is, oh, what we need to do as seed stage investors, for instance, is stop trying to hit the 100x and try to hit multiple 5 to 8x's and then return the fund that way. And it's like at pre-seed or seed, don't those people look exactly the same? Like, what is the difference between investing in a quote 100x idea versus a 10x or 5x idea at the seed stage? You're basically just betting on the founder, and if the founder's really good, they're going to look kind of similar.
My experience says there's something about the early ambition and drive that comes in earlier. If someone's aiming for a 5x, you might only get a 2 or a 3 because, again, life happens to the company.
Sure.
So if you don't aim to invest in a company to be a fund return or whatever that means, because it's relative,
Sure.
right, to your fund size.
Yep.
Because the odds of that happening are already so small, you haircut the potential of it significantly if you go out looking for a base hit versus a home run.
Yep.
And I'm sure there's some fund out there that's going to prove me wrong, but we've yet to see statistically, because it ends up being more private equity, funds being able to be a 3x net, heaven forbid even a 5x on a bunch of base hits. You have to, numerically, you just don't see it.
Yeah. You have to have the one.
You have
or
to have
two
something significant.
standing. Yeah.
Correct. And so I think it comes down to the ambitions of both the investor at some level and then the founders they pick. And you don't know where it's going to go, but you have to have that drive to be that much larger in your impact.
Yeah. So then the real question becomes, and this is, I guess, the evergreen question: Are the founders that these multi-stage funds are investing in going to be the best founders, right? Or is it that, yes, we as emerging managers might be priced out a certain segment of the market, but that leaves quite a lot of potential would-be fund returners that are not getting the attention from the giant funds, that they just don't have the pedigree or the right credibility, et cetera?
Time will tell. I mean, you definitely see different patterns. You see a lot of the large multi-stage mega funds going after repeat founders from their networks because for all of the proof points that they have that this person is extraordinary and compelling and can build a team and can do all the things they need them to do. But then you always have the people that come out from the side that are not prototypical of whatever this repeat founder looks like, and they also can produce. So I think if it was that easy and obvious, we would know by now.
Right. Yeah. It turns out the world is messy and it's not that simple.
And I also, this was in my head from this conference I went to yesterday, as technologies evolve, you're always looking for the next generation of founder that's coming out that understands the technology. And that there's some magic that sits in there that, again, not that a multi-stage fund couldn't find it,
right?
But this again goes to if you're out there doing the work and thinking through what does this technology enable and what are the next iterations of it, I think it keeps the door open.
Yeah.
In a way that.
So does that actually lessen the impact of a repeat founder because their first company wasn't in the AI age?
We see data on both sides. I think it comes down to the individual and are they learning and iterating? And every time you see people say you have to find folks that know the problem and have lived the problem, someone will bring up Flatiron Health and be like, well, they didn't and they made it work. So again, it goes back to if there was one, I say this all the time, if there was one simple answer, Harvard would have done a case study and would all be doing it and reading it. So the good news is it's not.
Right. So if you are a Harvard case study, I'm sorry.
No, it's good. It's nice too.
Sure,
but there's I love venture for many reasons, but one of it is there is no one way of doing any of these companies.
Yeah.
And that's great.
So you are at the moment bullish on emerging managers.
We've always been bullish on emerging managers as part of a LP portfolio.
What kind of part? And you say a part of, and obviously that depends on the LP, et cetera, but.
I know you took my answer. It does, well.
No easy answers.
No easy answers. So we've built one way of doing it. I see other LPs building different ways. The challenge is if you just stay with your managers, what we've seen is, depending on what your objective is, and if your objective is IRR and some TVPI, probably you could stay with a large set of platform funds. For a significant period of time. But we even see those LPs saying, but I need some new stuff because new ideas will come out.
Do they have like a set percentage of new stuff?
Usually people try in some ways.
So there is an internal discussion of like 15-20% of our mix needs to be new people.
I'm trying to parse it. I'm trying to quickly do the math on everyone we talk to. I think people end up with a playbook, and I don't know if it's always supernumerate because we have a separate pool of capital that we manage for CalSTRS that does emerging managers. So for us, it's very defined.
Yeah.
For folks like an endowment, just an example, or a foundation, they might want to have a consistent awareness and openness to it, but they might only add a new manager once every 24 months. And so it can be more of a, do we have dollars to deploy? We're interested.
Yeah.
But the bar is here because we need dollars to deploy, and either we have new capital for whatever reason, or we have to rotate somebody out.
Right.
And if you've been with someone for 5, 6, 7 funds, that's not a simple decision.
No.
And you also have to bet whoever you're letting into your program is going to be as productive as somebody that you've known and seen and the history of it. And I think it's hard to know as someone who's pitching an LP the state of their portfolio and how high the bar is. But I always recommend that GPs, when they're pitching, first ask the LP about their platform and what they're doing and what they're interested in, because you
Are they upfront about that kind of stuff? They give decent answers?
I would hope so.
Sure. Kind of tells you about your partner on the other side.
A little bit. You can learn a lot.
Sure.
And if there's no hope, you can then get advice.
Lovely.
Which is lovely because some of these LPs have seen, from an institutional level, even if not individual, 30 years of venture. I mean, there is a huge amount of knowledge in the room that I think is getting untapped.
So there's two things that come out of that answer. The first one is that there is not hidden, but perhaps under-discussed inertia from moving on from current portfolio or current managers in your portfolio as an LP, because you have this trust built up. You've maybe seen great funds and not so great funds from that same person or those same people. So like getting over that bar is actually not even just about, are your numbers better? But there's a whole other relationship layer that takes like precedence over that.
Correct. And you do hear some LPs talk about additional externalities of investing. Let's say I invested in Peter's fund and I care about what you're investing in and your numbers. But maybe I also get all those other insights that you have because you're doing data analysis and all these things. And that, even if it's not part of the specific math, it becomes part of the experience of the relationship.
Yep.
And that can be hard to then take out.
Yep.
Right.
And so then that also points to the fact that, and this is something I hear from emerging managers a lot, which is, there's the constant Twitter hoopla of so much capital is going to the mega funds and won't these LPs look at us? And then when you dig down into it, two things come out. One, it's a lot harder to write $20 million checks if you want to write 10 or 20 or 40 of them as opposed to one check, first off. And then two is like, and perhaps you disagree with this as an input for LPs, the literal team size of the LP investment team, where it's like, look, I actually believe in emerging managers, but I do not have the capacity to truly understand the market in a way where I feel confident adding a new portfolio manager to our mix.
We hear that all the time, and that is why, in many cases, fund-to-funds or OCIOs exist.
Yep.
Because I personally would not know how to invest in venture if I couldn't get out and meet with 100 people and do the work in the weeds or in the slop or whatever you want to call it. I don't think it's sloppy. I think it's beautiful.
No, the weeds are great.
But I appreciate the analogy. It's really hard. I have mad respect for teams that are, 5, 8 people that cover everything from venture to private equity to buyouts to publics to real estate. I mean, that is
outrageous.
It's outrageous. So it does.
It's got to be basically intellectually insatiable at that point, and like an incredibly high motor.
Correct. And it does create challenges for new entrants into the portfolio because you have to find a way in to get their attention.
Yep.
And then to your point, a lot of the challenges are also of check size. And then how concentrated do people want to be in a manager? And it's, I'll say this with love and respect, the reporting out of venture capital is de minimis compared to the reporting from private equity. And then publics, you can pretty much tell on the daily where things are at.
Sure.
Real estate and fixed income have their own dynamics. But it's a really tricky market to understand.
Is that a feature or a bug?
I think it's become a feature, but I would like it to be a bug.
It's spoken as though it's a feature from every emerging manager because, look, our timelines are long-term incentivized.
Yes.
We work with the founders over the long term. You don't have to judge day by day or quarter by quarter.
Correct. Although ironically, I would say some emerging managers produce more information for LPs because they'll say, hey, here's my Notion page. You can just come into it and see the companies.
Yeah.
Because the utilization of technology, I also think is a hidden strength of emerging managers. I see a lot more, because we're building fresh from day one. You do not have, I'm making this up, 20 years of an installed base of how you do your financial reporting, Excel, whatever it is that people used to use. And then now people are like, oh no, here's my Notion, here's my Airtable. You can build with me. You can just come in and see all of this real time, which is wildly different.
Yeah.
and really hard to unplug. We can even talk about AI, where we see some managers doing very interesting things. But if you are a 20-year-old firm, it's like any company, changing on a dime is incredibly hard.
Do the LPs know how to, when an emerging manager is approaching a new LP, do they try to tailor their reporting to that LP's needs? Or they're like, I use Notion, I use Airtable, like that's who I am, and you just kind of got to get used to it?
I imagine they would like to, but if you can tell me the number of average LPs in a fund, it becomes very tricky. You have to find some commonality.
Yes.
And the nice thing is financial reports are pretty standardized.
Yeah.
But we have found out interesting nuances around people then provide the qualitative. Is it a written report? Is it audio? Is it visual? You can do a lot more things.
Are there private podcasts that you get to listen to from your emerging managers?
No, but I do get videos. People will record things, not just from us, but we have some managers that do asynchronous portions of the AGM. So if they're reading the performance and you're just reading, it's like flipping the classroom.
For sure.
Here's the data. You can watch it at your leisure.
Yep.
And they'll get together and discuss, which I think is a wonderful use of time.
Yep.
You can do similar things with CEO presentations. And then again, because LPs are going to be varied in what they want, so you can... Annual meetings are huge time intensity from a production standpoint, so you can think through how to do it so that it becomes value add to both the GP and the LP.
I've always thought, I have now been to a couple dozen AGMs, and I have always thought, and they vary in terms of, some of them I feel like are incredibly focused on one or two things, and some of them you feel like it is a pastiche of 40, you meet a founder, you get a little bit of fund data, you meet another founder, you do market context. And both can work. It's just kind of what the managers want. But I have felt that it does feel as though if this annual meeting is the real point where you're conveying the vast majority of the information, there's a huge risk of it going right over people's heads, of being like, they didn't catch the important part, or like, of the 40 slides you showed, that was the one that we wanted to focus on. So how do you feel about annual general meetings?
I'm pro. Please do them.
Sure. Yeah. We're not saying get rid of them.
Well, there's some folks who... sometimes the larger funds will rotate doing them annually or not doing them, and then everyone else coming up the stack says, well, so-and-so does it this way, this must be best practice. And you say, well, it's one thing if you have 40 years of history and you've changed your annual meeting to reflect what your LPs want versus a standing start. And I had this conversation with a manager last night who used a demo in their annual meeting to show some AI things, which I thought sounded amazing.
Demo of a portfolio fund?
Yeah.
Okay.
And I thought it sounded amazing, and we love demos. And they said some of their LPs loved it and some didn't.
Yeah.
And my heart bleeds because I get it. You have a room of 40 LPs and they're not going to want the same thing. And then how do you, to your point, figure out how do you run your room?
Yeah.
But I do agree that if this is you can use multiple, I would actually suggest people think through all the points of contact they have with the LPs during the year, like quarterly letters, annual reports. You can provide a lot of information in different ways,
right,
not just relying on the annual meeting, because if someone does miss the one point you want to make in your annual meeting, that's a bummer.
It's a big deal.
That's a big deal.
Right. And you actually spoke about this on your own podcast, Origins, whichever one you listen to, about GPs could, especially in times of trouble, be too transparent with their LPs, or sort of give the message that we have all these learnings because we had all these failures, which is okay. We expect some failures, but don't temper it with enough optimism occasionally.
Yeah. So I did this. My partner, Laura, came on. We talked about this, and I wish I should get the quote right. She was so wonderfully thoughtful about it, which is exactly this. Think through how the message is conveyed.
Yeah.
Because we're all human. And there is this wonderful balance between here's what we learned and here's what we're going to do differently, or more of the same, whatever the answer is, versus freaking people out.
Yeah.
Which is a very uncouth way of saying what she said, much more intelligent.
Do people try to freak LPs out intentionally?
Oh, I don't think so.
Really? There's no contrarian emerging manager who's like, I want to tell you just how bad things are.
Oh, I have yet to meet that. I would think that's pretty spicy and interesting.
And it strikes me as contrarian enough that someone would have tried it. But you would know better than me. I don't read the letters.
I haven't seen it. And I do think there is if you make it all doom and gloom, there's obvious downside to that.
Yeah.
We do like it. And I'm going to start this actually by saying I talked to a CIO who I hold in really high regard, and I asked him about how managers, how much do they personally give advice? And they, of course, are always willing to give advice and say, here's what we've seen work, here's what we've not seen work. But she said the best managers self-correct. because it's a long-term game. The managers will see it first. By the time LPs hear about it, it's already happened.
Yeah.
And their experience was, to some level, people self-regulate. And the best ones, defined as over time performance, will have to modify based on the market or whatever is going on in the team or whatever it is. And so not that they don't take advice, but the self-regulation is an interesting part of becoming great and staying great. And that is stuck in my head.
Totally.
Yeah.
That also suggests that, the only reason why I would think the spicy doom and gloom thing might work in some cases is just that it would be a natural human tendency to gloss over things that are not going well. And then that makes things that are going well seem basically on par, right? You like lose the highlight of the real successes sometimes.
So you're reminding me, this was a long time ago. Do you remember the rest in peace memo that got leaked by Sequoia?
I read it, yeah.
So is that a doom and gloom example? Because it created such a stir. Yeah. It gave people a lot of latitude to actually discuss what was going on. It put CEOs on notice.
Founders, yes. I mean, definitely they expected it to be read by everyone in the venture community. So I'm sure that they were writing from a generalist perspective. But yeah, I would call that doom and gloom, right?
Yeah.
Yeah.
But it worked out.
Sure.
And
it worked out because they were first, or they were I feel like if they had been the fifth people to write that memo, it would not have been that impactful.
That is probably true. So there's value in that. And I feel that they've had a couple things like that. I mean, right now, I haven't gone through it in detail. Please forgive me, Sam Lessin. But he comes out with those fantastic slides that talk about the
I read everything you write, Sam. So I have gone through it in detail. It's not a big deal. Yeah.
Which isn't doom and gloom, but he's very good at saying, here's the state of play.
Sure. Yes.
He
made a case against startup equity, which I disagree with recently. But other than that, I agree.
Oh, that's going to be a good podcast. You guys should discuss that. So I don't know. I think real talk, I always value real talk.
Yes.
And then what people do, because what's harder is when people somehow manage to not notice the challenges in the space, in the room, and then it feels disingenuine. And then that erodes the trust, because we always ask folks about anti-portfolio and what we learned, because we have anti-portfolio, we're all alive investing.
Yep.
So there's stuff and nobody can do everything. So by definition, everybody has it.
Yeah.
And if you can't talk about it, that's also just one of those intellectual honesty questions that it's just.
Is your judgment on the anti-portfolio just about deal access? Like, what are you trying to get from their anti-portfolio?
A lot of, we've kind of, at least I should say I don't want to smear anybody else with my thinking. Is it just I don't understand how people think? And did you not have access? If so, are there certain networks you're not part of? And what does that matter? Does it not matter? What do you think of it? Did you get bid out? In that case, sometimes it is just a check size thing. So what does that tell you? It's much more about what did you learn? And we learned this. I mean, I've famously said this, so I'll say it again. We passed on the first initialized fund, which was a bad call from an investment standpoint.
Sure.
It went on to be highly productive. They were wonderful investors. I'm so sad, but it was an $8 million vehicle, and we launched a Series A focused LP vehicle, and it didn't fit.
Yeah.
But should we have broken our rules and tried to put money into an $8 million vehicle when we were trying to write bigger checks? Yeah. But I learned a lot from that.
Sure.
I learned, like, if someone's really special, can you break the rules and push yourself? And
such a mirror image of when a GP comes to you and says, I know I'm a biotech investor, but I met this AI SaaS founder and I had to because they were just so special.
Yes.
And when it works, amazing. And when it doesn't, there's the questions.
Yes.
Why did you break it?
It goes to if you're going to
if Gary hadn't been such a gigantic success and you put a lot of money into that $8 million fund, you'd have been like, why are we going off thesis?
Correct. It goes to you got to get it right.
Yes.
Which is hard to know.
For sure. Which brings us really neatly into, fund benchmarking, what LPs care about these days. Beyond the obvious stuff, are there, like, you just mentioned the anti-portfolio is a wonderful qualitative trust building exercise for these emerging managers. What other, like, qualitative things are you seeing the best emerging managers show LPs that are not hard data about how they make decisions or, like, building trust with those LPs initially?
My simplest rubric on this is having your own insight into something. I'm trying really hard to avoid first principles because I want to add more texture to it. But when someone comes to you and has an insight into a space and says, here's where it doesn't necessarily have to be a prepared mind thesis driven, but here's what I'm thinking and seeing. Here's how I have constructed my investing to be strategically advantageous to it. Mm-hmm. And then here's my firm or me, if it's a solo GP or has a team, and here's how we're going after it. And that whole product market fit alignment goes through. I think that resonates. And I think there's also then certain best practices around how do you then organize your fundraising to create momentum, because we see this today literally in the market. You see some emerging managers catch that fire and all of a sudden they are over allocated, even if they're raising 10 million, 30 million, 100 million. And it's hard because you get maybe 10 of those.
Right.
And then everybody says, well, what about the other 2,000 emerging managers? But I think a lot of folks don't understand the difference in the voice in the room, which says, I have found something interesting and here's my insight, versus I'm doing another venture fund and it feels run of the mill.
Yeah.
And in this market, run of the mill is really hard.
How does that work for a generalist fund? You had mentioned with Laura on one of your pods about 2020, everyone added crypto. And then you said, I'm sure that a lot of this isn't going to work out, but you kind of want to be a part of the thing that's happening in venture. Obviously, we have a thing that's happening in venture right now with AI. So I'm assuming when you talk to emerging managers these days, all of them have an AI thesis. But then how do you distinguish between who's has an actual superior insight or something novel and who is just kind of, we need to be in AI companies because that's what founders are built to?
I think my best answer is you have to do the work. And this goes to your comment about team. I mean, we'll meet with hundreds of folks. And if it's not always in person, because you only have so many hours in the day,
Sure.
But you'll look at decks, we'll go to conferences, you try to absorb the information so that when someone does spike and there's someone's AI narrative is slightly different or they have an insight, you can recognize the insight. And that's the job of the LPs.
Right. And you have to have enough experience or depth in the market to recognize something that is different.
Yeah. And so I was, again, at this conference yesterday and someone was talking about how they pick AI founders. And it was the same thing, which is if you only meet one,
right,
your muscle memory and your pattern recognition isn't going to be the same. So you have to go out and meet with a lot, which is why when people say you're starting out your career as an investor, take a ton of meetings or virtual chats or whatever it is you do.
The first person you meet.
Because you just don't know. And it's time intensive. I just don't think you can, I'm going to say this, I might die on this hill. I think you can't skip doing the work.
You might die on that hill.
I might die on
Oh
that
my
hill.
God. People would love to skip the work though. I personally would like to skip the work. Can I do that?
No, I mean, I would like to too.
Okay,
and
not allowed.
I don't know, maybe if you only, and you see this with some of the really, pedigree, top tier, consistently performing LPs and GPs, they probably get sent a really elite list of pre-screened through some mechanism. Either the seed managers only send their best of best deals, or you're an LP and you only get the best of the best referrals. But still, if you don't know, you don't know. And I don't know, I just think the work is a moat.
That would be it's obviously rarefied air. But at that point, you would have to wonder, if I'm only seeing the top elite thing, then I have to, by definition, be missing the newest thing that doesn't come from the same network.
You would think so. And I would love to, but I have not been invited to hang out in Sequoia Land and see how it works. But I would love to if you ever want to invite me.
Invitation open, Sequoia Land, which is a theme park based on venture capital, I guess.
My guess is they work really, really hard to stay at the level that they're at. And it's not I'm just going to look at the one deal that everybody sends me. It's I'm going to go out to exactly this reason.
Yep.
And they're original investors in the YC Start Fund. And I'm not sure they're first to have scouts, but they were probably pretty darn near close, if not the first. So there's a lot of hustle.
Yeah.
So
pro scout?
I think I am pro finding innovative ways to stay connected to the edge of the market. And then people have to think through how to do it and what the incentives are, because we see some scout programs that work and some don't, and scouts like it. I don't think there's one simple answer. And
it's like saying, are you pro accelerator? Like sometimes,
sometimes, how and why are you doing it? But this goes to the non-differentiated nature of a lot of folks. When someone comes to you and says, oh, now I'm doing a scout fund because everybody has one, we will ask why and how are you utilizing it? Because just because everybody has one doesn't make it great for Beezer or great for Peter.
Yeah.
And then we've seen some of our managers that had them morph them and say, oh, we noticed this incentive wasn't working, or we noticed we had a lot of insights but not a lot of deal flow, so we're remapping it. And this goes to my comment of great managers will just self-regulate because they're learning all the time. And they should have a really high expectation for the return on their time, because we all have that limit.
Right.
So it evolves, and we're cool with that.
Are you, on the differentiation point, do you think that it has gotten much harder to stand out as a manager in venture over the last 5 or 6 years?
I think at certain stages of the market, I think at the sort of pre-seed seed where there's a lot of new entrants all the time, and the absolute number flexes, but relatively it's always the largest section of the market.
Yes, definitely.
And I think everyone says barbell. I don't entirely maybe from a dollars, it's not a perfect barbell because you have tons of small funds, but the dollars don't add up to $120 billion.
It's not a barbell. It's more of a pyramid than it is than it is.
But it's a really weird pyramid.
It's strange. Yes. It's a amorphous, like abstract shape. Yes.
Totally.
Sure.
I'm going to need an AI answer to this because everyone uses the word barbell and I'm like,
new geometry.
I'm like, it's kind of not. I'm like, so my point is when you get into the narrowing portion, no, that becomes easier to see because you get track record and data.
Yeah.
And then it's, again, at the top, you see it. So that's very clarifying. And I think the good news, bad news in this market, the longer we extend the liquidity trough that we're in, the more and more clarifying it seems because not only does I don't think anyone expects, well, I would love to have more DPI right now in this market, but if the exits aren't happening, we can talk about secondaries as a
You said it.
contributor.
The red flag. We're going to talk about it.
We're going to talk about it. Excellent. It's actually I'm actually really energized by this topic.
Secondaries?
Secondaries, yeah.
You're the first.
Well, no.
People are getting excited about it, but I feel like it is to use the term, manufactured excitement.
Correct. But I guess to finish the other point is I do think as whatever this is, funnel, pyramid, barbell, it does become easier to see performance.
Yep.
Because you can also look at the companies and see how they're doing.
Right.
Whereas in the early stages, it's just a lot of unknown.
Yeah.
But
and the signal is it's one of the things that I think I underestimated about startups when I started thinking about this, even when I just got out of college, I was thinking about startups and how to join them. In my head, I was saying, a Series A startup is so much further along than a seed stage startup. They've de-risked so many things, and you get in, you're like, not really. Not like the gap between where these companies are and how much risk is left is all over the place. It's incredibly widely distributed.
Yes, I mean, unless I put everybody who invests in ventures a venture specialist, but if you're doing buyouts and everything else, no, the difference is minuscule.
Yeah, tiny.
I mean, if you dig our noses into it, yes. And I think your data is also showing that we're going back to what I would consider typical pre-2018 land, which is, there is probably 2 years between seed and Series A.
Yes.
And so there is some de-risking that is occurring, but it just depends on how, are you 100,000 feet above that or in space?
Right. When you're looking down and you're like, these two dots on this map are exactly the same. Yeah.
Like these companies are still quite young.
What are you talking about? It's a difference of $500,000 in ARR. Like it doesn't make sense. Yeah. All right, let's talk about it. Secondaries time.
Excellent.
So there's been a lot of opinions about this. I thought that Hunter Walk wrote a great one from Homebrew, wrote a great one around like, this is now a permanent feature. I think it's a little bit overblown that it wasn't a permanent feature before. Like, I think it's been around for a long time.
Yes, and I would say, and Will Quist, this is a shout out to you. Will Quist and Slow was looking at this before.
Yes.
So I think Hunter did a masterful job of synthesizing it for digestion. But yes, 100% happening before. And, and I think it's an intriguing, news not the right word, reemergence of a past behavior.
Yep.
Right.
So my question isn't really whether or not this is going to stick around or if it's a good idea or a bad idea. I think the answer is obviously 1, yes, and 2, depends on your relationship with the founder, on your fund, et cetera, on your relationship with your LPs. What I'm really interested in is the weird, like, it's not a stigma, but it's this hesitation of we have defined ourselves as IPO or bust. We are in it for the long term. And so is some of the problem with secondaries just that the managers feel as though this wasn't the goal?
Yes.
And so they kind of feel awkward about doing it.
100%. I think the word that I would like to see is sort of normalize it as an option. Or maybe option is the wrong word. As a part of the market that one can pull on at different times depending on certain scenarios. So you just have, maybe option is the right word. Yeah, obviously when something runs the long way and it's hugely performance both at, during the private world and then the public market, way more value is created.
Absolutely.
Like you cannot, the secondary market is not deep enough to create $1 trillion situation.
No.
The public markets are. So
yes.
They own that game. You could not do a secondary to buy Wiz at $32 billion. That would be the majority of the secondary market.
For sure. Yes. Yeah. More than half. Yeah.
More than half. So obviously the bigger, better dollars live out there.
Yeah.
But there is a whole bunch of other very smart financial engineering isn't the word, but financial tools that one can use secondaries
But it is
for.
kind of financial. So
A little bit.
This is the other emotional part to me that kind of I think is tripping people up. But tell me if you disagree. That is it weird to take money out of a thing that isn't quote producing yet? You know, like it's almost like so imagine you took a secondary out of a company that had raised a couple of price rounds in quick succession.
Mm-hmm.
Based on what we've just seen in 2021 and beyond, there's no guarantee that that company actually ends up being worth anything. So you took cash out of a thing that ended up at zero, even though the long term of every company is, of course, zero, right? Apple will go to zero at some point in the life cycle. But taking it out that early, I feel like causes, again, some uneasiness because it's like, am I taking cash out of a thing that isn't still ephemeral? I don't really know what it is.
Probably the answer is yes, but I've seen managers make money on stocks in a very honest way, right? They'll distribute when the stock is high, and if an LP sells, they've made money, and then the company craters.
100%.
Kind of no different.
Yes.
So yes, my experience is people, it's a muscle. Thinking about the exit in venture has always been a sort of last bullet point on the PowerPoint discussion.
Sure.
I think it belongs in a more healthier conversation. It's definitely part of the discussion in private equity, and you got different levers because you're a minority owner in venture, so it's just a different game.
Yeah.
But I think it also starts also in the CEO conversation, because when I've been asking GPs, because I think we always wave our hands and say, oh, just do a secondary, but the CEO and the company employees are all part of that discussion, and if they don't want it, my understanding is it can't happen. Yeah. And I've been hearing discussions around what you do at the term sheet level to open up the door to that, which I thought was fascinating because, again, you have to create you have to set the table the whole way through.
Right.
And do what's digestible to the CEO, because certainly CEOs take secondaries. And sometimes that's also with the other employees in the company. Sometimes it's not during different rounds, we hope. We can get into all the incentive challenges there, but they're kind of obvious. Yeah. But do they want people that they do not know on their cap table? I understand why that feels uncomfortable.
For sure.
Right? You don't want to have somebody own a piece of you that you haven't authorized. That feels weird and uncomfortable. But so how do you address that in a term sheet? Do you allow, because a lot of times in an LPA, LPs may have different vehicles they invest out of, and you can transfer sort of internally. Yeah. So do you create a term sheet that allows for internal transfer amongst the cap table? So GPs could do it, because again, if you have a crossover GP coming into a cap table later, maybe they become part of the secondary dynamic.
Buy you out, buy the early investors
and just buy
out.
these seed investors out, because if a seed investor, is a simple rule of thumb, can sell 25% of their ownership in a company and significantly either return a whole fund or a portion of a fund, and you still have a lot to run, you can kind of balance the equation of, are you selling too early versus getting some money back and recycling and all those healthy things.
It's my understanding that a secondary is almost never complete. It's not as though you're selling out the entire position in most cases. Or
Correct.
I think that's usually right? It's variance, obviously, in the percentage, but it's not as though you go, okay, we have now exited that company fully.
I think I don't have the data, which always makes me hesitant, but anecdotally feels unusual.
Yeah.
You do see secondaries on the LP side where you sell your whole position in a fund. So on that side, it can be absolute. You can see strip sales. This is getting a little technical, but it does go back to the financial engineering of it being as sophisticated in thinking on the coming out as the going in. Yeah. I do think is a muscle that's underdeveloped in venture.
Yeah. And I want to shout out Dan Gray, Credit Stick on Twitter, one of my new favorite follows, but really kind of pushing me and many others to think critically about the financial backgrounds of VCs and the ability for you to think financially across the stack that way. The other point that you just mentioned, though, is going back to an earlier question I had, what are qualitative ways for GPs to stand out? Being able to win the right deals with secondary transfer in the term sheet, I think would be a great bullet point for LPs to say this person is, one, thinking about that, and then two, still able to convince the founders that they're the right money.
Correct, because the concern that I've heard from GPs is if they stick that term in,
they lose the deal.
They lose the deal.
Absolutely.
So it goes back to the normalizing it amongst the discussion. So how do you create it so it's not, you do not want to invite disruptive capital onto a company's cap table. So how do we think about this and do it in a healthy way? Because everyone should be aligned in wanting the company to be successful. And if you start with that goal in mind, there's so many smart people. I think we could figure this out.
It seems as though that suggests that one of the pieces there has to be founder secondaries then too.
Maybe.
Because then you are in alignment. We're early, you're early. We're going to take money off the table. perhaps at similar times, or if you do, we can, etc. So we're aligned to you, but we also understand how to make money throughout this 14-year private journey, 15-year private journey. Like, I don't know when these companies are ever going to
So
look.
I had this thought bubble yesterday sitting at this conference, being like, what if we pulled together all the relevant actors, including lawyers, and sat down with CEOs and lawyers and said, how do we
have to
do
bring
this?
lawyers into this?
If they're writing the documents,
Really?
yes.
Okay, fair enough.
Yes.
Yeah, fair enough. We love you, lawyers.
Yeah, we love you. Well, only because, and also if I'm sure this happens at the CEO level, we hear it all the time. Well, 16 GPs have agreed to this clause. This now needs to be part of the LPA. So and the lawyer becomes the go-between in that discussion.
Yep.
So I don't know. I just had this very simple thought of, well, if we're all going to have to utilize secondaries in the absence of significant M&A and IPOs coming back, if venture is to keep moving forward and have liquidity, because at some point, it does become a real issue if there isn't.
Yep.
And in this macro, like way beyond my crystal ball to know what's going to happen with tariffs and all of that.
Sure.
So what do we do? And if we have to have I don't know how it's like the challenge of the commons, but could we have a conversation and start creating some new norms?
It feels like a new model in VCA doc or a priced round that includes secondary transfer regulation, or at least sets out a menu on which people can build, because it's not going to be the same all the time. Like, I totally understand. And some of that is leverage from the investor, some of that is leverage from the founder, et cetera. There's going to be differences, but I don't even know if there's like any sort of standardization across how that happens on the term sheet or the LPA level.
I don't know. And there's probably all sorts of internal audit and tax implications at pricing that I'm not taking into account. But when I've asked some CEOs, it brings up all sorts of issues, which this then goes to when people wave their hands at something. It always irks me a little bit, because I think, well, for somebody, this is actually a real issue. And they probably are not okay with the hand waving saying, why don't you just do X?
Sure.
So let's unpack why X is not happening and understand it always comes down to incentives.
Yep.
And how do we make them better? Because why not have more options?
Totally agree. So is in Thomas, you had Thomas Christensen on, and his word was ventures broken.
Oh.
I believe he said ventures broken, and then you kind of dug into that. Do you agree? Is venture broken? Have we been broken by the lack of liquidity?
It is a huge challenge. I'm hoping it doesn't break us, or not irreparably.
Do you think that this is the worst liquidity crunch in venture history?
Well, I lived through the dot-com bust, and I do think it could be similar. We might see the same level of compression on the dollars going into venture on a relative basis. And we might see the same number of, I hate to use this term, but winnowing of funds, and just because the dollars are concentrating and they're going to continue to concentrate. And your numbers show they're concentrating in companies. So
absolutely,
that is absolutely happening. And it's not impossible to believe it'll be a 4 to 5 year run, because it's now the end of, it's the 1st of May.
It's the 1st of May.
Happy May Day.
Happy May Day to you. We should have led with that, of course. Yes, of course.
But so I just do simple math, which is if you're not having an IPO in the near term, which I don't know who is, but you have a 6-month clock on the back of whenever that thing happens, and then GPs have to decide to distribute. So we are easily in 2026 now for any IPO distribution, easily.
Absolutely, yeah.
And M&A is happening. We have a couple obvious examples already in 2025, but insufficient to feed the overall liquidity deficit.
It's another 18 months for any sort of regular liquidity at all.
So we're at a 5-year trough, which was not dissimilar.
Yeah.
The good news today is that no one thinks the internet or AI or software is dead. Whereas back then, people really thought venture didn't exist because they didn't think software and the internet was a thing.
And some of the macro, if you just looked at the alternative, some people might go, well, I don't know, locking my money up for 5 years on a slightly riskier bet might be worthwhile.
Correct. So I think what we have today is an economic challenge in venture, not is there no value in innovation?
Right. Yes.
So this is why I've been really thinking through the secondaries and the impact, because it's a little bit of, can we all stay alive on a liquidity, like, can you stay rational as long as the markets are rational, whatever that quote is,
sure. Yeah.
Which really in this world comes down to liquidity. Same thing for founders. Can you build your company and raise the money that you need? Because we're all going to have to figure it out for another 18 months.
Yeah.
I mean, I hope world reverts to a wonderful bull market, blah, blah, blah. But I don't know. I can't make that happen.
I totally agree. I think there's you said it very well. There's no foundational problem with like funding innovative companies. It's a money issue.
It's a money
It's
issue.
a money issue. And so then you need some, in this case, I don't think you need the stigma around the word financial engineering. You do need to figure out the way the financials work so that everyone can stay afloat and
Yes.
solvent in a period of low liquidity. And it's not like this is going to be the last period of low liquidity. So if what comes out of this is really effective secondary mechanisms that make the whole stronger, I think it actually could be very useful.
I totally agree.
Yeah.
And venture's wonderfully wonky in that it always has these sort of simple rules of thumbs that we think are true, but I think underneath it is more complicated.
Well, that's the thing. It's a weird part of finance because it is both Wild West, right? Trust this person. You have not a lot of data to go on. Like, this is about belief. But it also, because it has gotten so much bigger, sort of demands professionalization in a way that perhaps this crisis is going to input onto people.
Yeah.
It's like, you can't just YOLO money into random companies. You have to have pathways out.
Could you ever just YOLO it?
I mean, I think you could try. 2021, there was a lot of YOLOing into private companies. Let me tell you, that is exciting.
I know. I kind of like being old, despite ageism and all
You heard
this
it here
stuff, but-
first. Yeah.
Well, because you have this perspective when you think, no, a lot of this is just the whole, again, quoting Sam, the whole factory line of fundraising was an aberration.
Mm-hmm.
And I was actually reading, shout out to Gil Dibner, who writes Angular Ventures newsletter, and he did this wonderful synopsis on it, which is, no, this is how it used to be. It used to be a 2-year run to Series A. And I was like, yeah, it wasn't a given that you could raise. And I think this is the world we're living in. And
I mean, you see that in the explosion of terms, right? Seed didn't exist and now pre-seed exists, et cetera, where it feels as though the race is through checkpoints, when really that is a mental model that has been placed on an incredibly messy, random thing that probably isn't going to conform to this mental model all the time. And it did for a while because interest rates were low and all this stuff. But that doesn't mean it needs to moving forward.
Correct. And I think part of being financially sophisticated is also that it's lovely to live in venture and think, oh, the future, today challenges in the market are less relevant because I'm not trying to go public today.
Right.
But you're building a business today.
Yeah.
And I think it goes to we all kind of hand waved on zero interest rates, but intellectually, honestly, that was not going to continue for forever. And so do you just think a couple steps ahead of how do I build in this market? Because I have to both play the game in the business world today, but also be hopeful about the future being different, which is what makes early stage amazing because the future is by definition going to be different.
And better.
And better.
We hope. Yeah.
We hope, which was why we all love it.
Exactly. Okay, I have a couple wrap-up questions about Sapphire.
Excellent.
And you particularly. Because I do think, and I'm not just blowing up your spot here, I do think that you occupy a different position than most LPs in the ecosystem, in that you have gone through your own media channels to the world. Why don't more LPs do that? Is it because they don't need to? Like, what is it about the LP? Because we've seen an explosion of it on the GP side. I mean, everyone has a podcast. Everyone's doing media content. And there's cool niches. Everyone's writing cool newsletters. Like, there's so much good information out there. I don't see the same explosion on the LP side.
No, and I would welcome it.
Sure,
I think it'd be fascinating. I love it. I think you're 100% right. A lot of folks simply do not need to, and it's a lot of work.
Sure.
Right? You do not need to tell people the name Harvard. They have 100 years of that, and all the other. There's a million lovely schools, but their whole business and hospitals and all these things, their business is getting their name out there. So if you're the capital allocator in the endowment,
and it's a waste of time, effectively, for you. Everyone already knows.
Everybody already knows. They might not know what you yourself are thinking and how you're managing your portfolio, but they know the name of your entity. And for folks that are not in endowments or foundations, I think it would be helpful, but it's a lot of work. And if it doesn't ROI for the time work, your day job is investing.
Yeah.
So you can't screw that up. Like that is the bright line of.
You heard it here first.
Totally. Well, you'll say, why don't you do X, Y, Z? I'm like, well, my day job is actually this.
Surely.
I need to do my day job.
I need to be good at that.
I need to be good at that.
Yeah.
So for us, it's always been about and I think because we are a slightly different kind of entity, it allows us this latitude where it can be part of the virtual cycle and virtuous versus taking it away. But we also have a team. It's not just me at Sapphire.
Of course. Yeah.
But you do see me doing more of this. I mean, Laura and Nate join me. We do things, but part of it is because everyone has to do different parts of the doing the day job.
What have been the biggest benefits to Sapphire from sort of an expanded presence?
I think we're smarter. I mean, because to do these, you have to listen to other people
Sure.
and digest their thoughts. And we use OpenLP to also create a platform for sharing. It's very mission driven, actually. But it means I read this stuff and then I become smarter and then we can share it with other people because I will also die in this. I'm going to die on a lot of hills, apparently.
Yeah, you have to have like 9 lives.
I'm going to be a cat.
You're going to be dead. Yeah, I was dead on the first hill already, which was, I believe, work hard, if I remember correctly.
But I've said this a billion times. Portfolio construction should not be your moat. Right? The whole venture industry, I think, would be, people can choose a different portfolio construction. There is no one size fits all, blah, blah, blah. But those kind of things, which is why OpenLP and others are out there, so you can hear what people think on these subjects, that should be table stakes.
Yeah. Because
then you're just smarter. It's the same way back in the day when First Round had a community for helping to educate CEOs, because it's just better.
Yeah.
Like, why is information education not better?
You make fewer mistakes, but also then you have like, I've found it incredibly useful intellectually to have something to butt up against.
Yeah.
Right? You're like, okay, I understand this person's point of view and I can understand why I disagree with it,
Correct.
Which is as important as figuring out what my point of view is in the first place, right? And so I just think that you're doing a service to the venture community as a whole, and I would encourage more LPs to take it. And I think there is a significant difference between appearing on a wonderful podcast like this one or David Weisberg's like 10X Capital, et cetera, and doing it yourself, like being a creator of thought leadership or content in that way yourself, just because the production function is very different.
Correct. And I'm definitely a activity-based learner. So for me, it just makes me and I think Sapphire a better investor, because is it video? Is it audio? What are people using? How are people digesting content? And then you watch how companies build and how do they get their messages out there? How do we as humans evolve? Because venture is about investing in humans, be it at the CEO, founder level or at the GP level. And it's just, you just become so much smarter. Yeah. So it's wonderfully self-serving, at the same time serving the community. And one of the firms I worked at back in the day was a Midyar network that Pierre Midyar started. And he always talked about the value of motivated self-interest. And that was one of the underpinnings of eBay. And it just sticks in my head. I'm like, if you can find this through lane where everybody benefits from doing something, it enables you to get up every day and do your work.
Absolutely.
Because it is a lot of work.
For sure.
And this is why we only do Origins a certain cadence.
Yeah.
Same thing for Nick Charles, who has to get the original credit for launching Origins. We are the...
Thank you, Nick.
Yes. He's now done 100 episodes. We have not done 100 episodes. So again, big props.
100 is a lot.
Asylum.
You know?
100 is a lot.
Yeah. You were on with Harry recently, right? Harry Stebbings, and he's like at 1,000. Like, I don't know how many he's done. It's wild.
He's been doing it for years.
Yeah.
I mean, that's
he
how
runs
he learned
marathons,
that.
so he's got the endurance for it anyways. Yeah.
So much energy.
Harry, come on the pod.
I know. So we do it, but we thought very long and hard before we started. And OpenLP is now almost a decade old. And I think Origins is probably pretty close, because Nick came to me almost simultaneous to us launching OpenLP and say, I had this idea for a podcast and it's all about the LP voice and getting behind the curtain. And I said, Nick and I I so love his thinking. He and I have had long chats about venture, and I was not surprised to see that he went that way, but it was sort of serendipity developments.
Sure.
And then that's how we ended up co-hosting, is because we end up chatting about it all the time. And it's fun doing things in pairs.
It's so much fun. I need to find a sparring partner. Okay, last question from me. What is something that you've seen one of your emerging managers do for a founder that you found to be different or unique, or, kind of, this is not just capital, we are actually helping, investing in, advancing the business that we've invested into?
You mean a different value-add service?
Value-add service, a personal thing? Like, is there something that sticks in your head of like, wow, that emerging manager went above and beyond for a specific founder?
Oh, that's so interesting. I'm trying to think of just one example. I think it goes back to, so do you know Lon at Basis Set?
I've never met. Yes, but
wonderfully interesting person building a really intriguing firm. And I always think of her as back in the day, it was probably called machine learning, but sort of AI forward first, because it's how...
If it's boring, it's machine learning, but if it's exciting, it's AI. Yeah.
But so I don't have her permission to share all the things that she does, but she's very smart at how she thinks through how to leverage technology and how that works both on behalf of her firm as well as for her founders. I'd love spending time with her because she always makes my brain explode in all the best ways.
That's awesome.
Yeah.
Is there, okay, you mentioned AI again. I realized I hadn't picked up this question earlier. You said you are seeing in the emerging manager base more and more people having AI incorporated into their funds and using it in interesting ways. Um, uh, w- is that a widespread thing? Is it just starting out? Like, where is the level of AI within emerging manager funds themselves?
I don't think it's everywhere. I think it depends on if they're investing in AI, they hopefully are using AI internally from a eating your own dog food. So I think that naturally happens with folks that are investing in AI intelligent companies. And again, Launit Basis, that's a great example of that. I think for other folks, I don't know if you're doing climate, if it hinges on the same things, maybe.
Sure.
I was at a dinner last night. We went around the room and talked about how folks were using AI personally as well as professionally. And there was a lot of consistency, right? And how do you be smarter, faster on research? How do you stress test ideas?
Anything that was like wildly different? Somebody doing something way off the map?
Not really. But I would say, and this is going to be a shout out to Union Square as an example of a firm with a long history of operating that is using AI. I mean, I love following their librarian on Twitter because they have essentially open sourced their dialogue. And Matt there has been really interesting. And it's whenever I ask him how he does it, it's not some secret AI chatbot that you and I don't have access to. He's just putting it together because he's thinking about it. Like, what is interesting about what I can create with this? What does the world want to hear? And Union Square very publicly talks about how they are a conversation.
Right.
And then he's showing it to us. And I would like to be part of that conversation.
Right. Yeah. It's an invitation in. Yeah.
But it's like,
sure.
I'm offering these two examples because I think emerging managers just have a leg up in they're naturally building new. And if you're building new with new technologies, you're going to, by definition, just form following function. But you do have folks like Union Square who have probably always been rethinking how they have a conversation, but have now putting it out there so folks can follow along.
Yeah.
Oh, it's pretty darn cool.
It's pretty awesome. Obviously, I could talk to you for many, many more hours, but thank you so much for coming on the pod. I really enjoyed this.
Oh, thank you for having me. It's been a long time dream to be in the studio.
Well, we will have you back soon. Until next time.
All right. Thank you.
Thanks, Beezer.